Hey everyone, welcome to the Story Trading Weekly Meetup. We got an exciting program tonight. We're going to have an update on SMSI earnings, but first we're going to go through a bunch of macroeconomic stuff and continue the conversation we've been having the last 2 weeks on the Ukraine war and how to profit from that. First, quick disclaimer, Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. This meeting is being recorded. The Q&A session at the very end will not end up on social media, but the presentation part will be up on social media in about a week. So I just want to start with this quote I found. A little different schedule tonight, but investing is anticipating the anticipation of others. I came across this quote as I was reading up on gold, and it's a quote from John Maynard Keynes, who has, I think he was the Keynesian economics, Keynesian economics came from him. So this is a quote that really was interesting to me because it really encapsulates how I invest, right? So I haven't really talked about this or described this in detail, but we always talk about the 4 pillars. So how's that different than the 4 pillars? So the 4 pillars at Story Trading: sentiment, catalysts, fundamentals, and technicals. That's all about understanding. It's seeking to understand why is a stock priced where it is. And as you know, a controversial topic among some, because I believe markets are efficient, that causes me to seek out why, always asking why? Why is a stock undervalued? Why is it overvalued? What are the opinions and perceptions of all market participants causing the stock to be priced where it's at? But that just gives you information. That gives you understanding. How do you make money off of that understanding? And it goes back to this for me. Once you have that understanding, now you can anticipate what other people are going to be doing, right? But you want to get in a little before them. So you want to anticipate how others are going to anticipate to changes in the story and changes in catalysts. So that's exactly how I approach all of my investing. I found that quote to be very interesting. So once you understand the market, you understand why is a certain price, a certain stock price where it is, that's when you can really dominate it. And how can you do that? Because now you can identify the catalyst which disproves the bear theses, right? You can identify catalysts which disproves the bull theses, because built into the price is a bull thesis and a bear thesis, right? So if you want to change in direction, you got to have something to disprove the bulls or the bears. Or built into price are expectations, right? What is the status quo? What is the expectations everyone has? So now if there's some unexpected development, you can be quick to recognize that and then react quickly to catalysts. And again, anticipate how others will react, right? And that's my whole approach to story trading. I love it. I breathe it. I eat it. I love it. It's just everything I do is about that, understanding everyone, the net market opinion of all participants. When you have that understanding, that story trading understanding, you're in a much better position to come up with your trade and investment ideas. And because of this approach, man, I'm going to boast a little bit, because since like November, I've been spot on identifying a lot of trends. There was one thing that didn't work out, the January effect trade just quite didn't work out, but we were able to identify the ARKK top and the reasons for that. With the chatter of interest rates coming up. So you had this risk asset sell-off, and I was looking at the technicals, the 200-week moving average. We saw that really early. We correctly identified the definition of what a risk asset is, right? Not just ARKK and not just these growth companies, but microcap companies, biotech companies, any companies not making money. They're all considered risk assets, and it all had to do with interest rates and expectations that interest rates would go up. So that caused me to avoid stocks like SMSI and a lot of others over the last few months. So also identified the inflection point in gold, identified risk of recession. So far, correctly anticipating sell-off of major indices and correctly identifying Russian-Ukraine trade ideas. This is all coming from deep research. I mean, I spend probably 80 hours a week just reading, right? Reading what other people are thinking, reading articles, reading tweets, reading everything I can to understand the market and why the market is priced where it is. And that enables me to anticipate the anticipation of others. So I want to quickly talk about what we've been talking about the last couple of weeks, which is the war in Ukraine, right? And how you can make money from that. So a couple of weeks ago, I introduced the idea of these new mega trends, right? Commodities, defense spending, energy independence, agriculture plays. And I put this little note here, just like COVID presented an opportunity for a major shift in our economy, so can this war. Themes like made in the USA, energy independence, agriculture, all these sectors will be here regardless of the outcome of this war, whether there's a peace this week or a ceasefire or there isn't, right? What Russia did is going to cause all of these issues for the long term and all these opportunities for the long term. And just like, right, I'm pretty bearish on the market, as many of you know, but a caveat to that, just like the internet tech stocks brought us out of COVID, right? These sectors can potentially bring us out of the current bear market we just are getting into right now. And we just got validated by Merrill Lynch. I was so happy to see this. They said the new FANG, fuels, aerospace, agriculture, nuclear, gold, right? And I've been changing up my longs, and I've been putting some of my longs into these positions here because I believe these sectors are really underinvested in, and there's going to be a lot of investment in all of these sectors. So why is that? Let's recap the Russia war mega trend play. There's really two main things, but two dynamics here. One is higher commodity prices because of sanctions, and the other is lack of trust, right? But not just with Russia. Think China, right? So now you can have this super cycle mega trend of defense and made in the USA. Now, Biden hinted at it already at the State of the Union address. I never heard him say this, like made in the USA, that's going to be a focus. That was just his SOTU address just a few days after the invasion in Ukraine. Hopefully, or I don't know if that was just something he said once, but I'm guessing not. It's going to come up again politically, and it's going to come up in relation to China, right? If we can't trust Russia, how can we trust China? So I think you can potentially see over the next decade, you can see tons of political changes coming in, tons of money and investment coming into the United States to make us independent and we're not going to be fully independent, but become less dependent, especially on Russia and China. So these are the two main themes making fuel, agriculture, nuclear, defense, made in the USA, all going to be very strong here as mega trends. I think these are going to be the next bull market stocks. So this is a repeat. Okay. So yeah, I wanted to talk a little bit now about markets and my outlook for them. So those of you who remember the ARKK early November, I notated the risk and growth stocks, and that had to do with two factors. The technicals, as you can see, like right over here, there was a little level, I forgot exactly which day it was, but there was a level that broke there combined with the chatter of higher interest rates, right? And that got me to think growth stocks, risk assets, not good. And I was eyeing the 200-week moving average, which is that blue line. And at the time I said, I think that 200-week moving average would be a place where it can bounce off of, but not be the ultimate low. I was half right because it didn't even bounce off it. It went right through it, right? So I was right that it wasn't the ultimate low, but I mean, a little bit of, consolidation at the 200-week moving average, but it really didn't bounce off the 200-week moving average. And if you remember, there was a chart going around on social media, which I shared in our community, comparing ARKK chart pattern to the Nasdaq bust after .com. And I thought this could be a very similar situation because of the overvaluation. And if you look at the revenue to price multiple, still, even in a stock like Shopify, still very high. I think stock I don't have the chart here, but I think Shopify can still come down significantly. So it's very possible we repeat this, and that would kind of maybe ARKK bottoms out in the mid 40s or something, maybe another 20% down or so possibly. So, but here's the question. I've been avoiding ARKK, but I've been talking a lot about the major indices, especially QQQ, right? And I just love that 200-week moving average. It's served me well twice now, and I'm seeing if I can go for 3, right? The 2 times it worked for me was in the COVID crash when I was expecting the market to crash. Again, I eyed that 200-week moving average as my target. This move right here really made my year and really, frankly, made my career, took my assets to the next level by buying puts and expecting this to get to the 200-week moving average, which it did. And then you can see the COVID, the ARK also, although it didn't bounce, but it reached it and even got worse. So now again, I'm thinking the QQQ can hit the 200-week moving average. So why is that? Because why I think this, my belief is on a longer term basis, the 200-week moving average is a bull support line, right? So correcting to the 200-week moving average is not even the end of the world, right? If this goes all the way to 200-week moving average, you're still above the pre-COVID lows. So it's not such a big deal, right? We're already down like 20, 22%. I think it's another 20, 22% to get there. So that seems like, oh my gosh, that's the end of the world. But not really. When he came up all this much, it's not even a bear market to me. This is just a correction, right? So it's like no big deal to expect this to go to the 200-week moving average. But there's a problem here. The problem is the QQQ is really being held up by like 3 or 4 stocks. Apple, Google, Microsoft, well, Facebook already kind of failed, right? But Apple, Google, Microsoft, and a few other really big caps are holding up the Qs. If you look underneath that, most other stocks already, are probably at that 200-week moving average or below. So how does this index get to the 200-week moving average? How could it possibly happen? It can only happen if Apple, Google, and Microsoft have a bad day, meaning a bad quarter or a bad capitulation or something. So what can happen here? So one of these companies will have to fall significantly, I think probably due to recession. So we're talking about the impact of the war on recession, obviously higher commodity prices, supply chain issues. There's increased chatter now. I've been talking about a recession for a few months, but now you're finally seeing institutions and Wall Street talk about an increasing chance of recession. That's perhaps the war is catalyzing that a little bit more, but you're seeing the signs of decreased consumer confidence out there. I think you're going to see decreased consumer discretionary budgets out there, and possibly we can even end up in stagflation. Here it is, Goldman Sachs now admitting it. So this is just a note, like a couple of days ago, I believe, a recessionary storm could be forming off into the distance amid a host of inflationary and geopolitical concerns, warns strategists at Goldman Sachs. We now see the risk that the U.S. enters the recession during the next year is broadly in line with the 20 to 35% odds currently implied by models based on the slope of the yield curve. So we'll see what happens. I think the odds of that are higher, but so again, going back to how can the Nasdaq crash? Apple. So with decreased discretionary spending and what's going on in Europe, I think they're going to have less sales. Obviously, I think they're out of Russia. No one's buying an iPhone or in Ukraine. And in fact, all of Europe, I think, will be impacted. I mean, this is the first big war since World War II. People are probably, this is not their priority to go out and get like luxury goods and the latest iPhone. People are thinking like, energy prices are going through the roof. My neighbors are in a war. There's 2.5 million, refugees coming into our countries. Maybe we should spend our money and help someone and house them. And even if you don't, I think there's going to be like this sentiment of just kind of feeling bad of like, hey, if people all around me are suffering, do I really need to go out and buy something? That's my view with the less discretionary spending. So I expect Apple to either miss or lower guidance on its next quarterly report, or possibly even before that. Now, they have a lot of levers to pull. I just saw over this weekend, they said that they're going to be excluding chargers and headsets in their iPhones going forward. And it's going to save them like $6 billion. Now, is that enough? I don't know. I don't know if it's going to be enough. I have a feeling not. Why? Because I just have this bias, going back to this chart, that this NASDAQ has to get towards that line. So if it has to get there, what has to happen? It has to be the Apple, Google, and Microsoft. And you're going to see decreased ad spending at Google. The reason I'm last week, I put a trade idea out there to short Apple. I introduced that idea on Wolf Financial Spaces on Tuesday night, talked about it in our community last week. The reason I'm choosing Apple is because I think it's probably most people don't expect it, right? They think it's the strongest company, so it will never happen. So I'm expecting maybe a bigger fall once the shit hits the fan, excuse my language. But Google, you'll have lower advertising expense, budgets out there during a recession. Microsoft, I think, maybe a little better off because that's productivity. But any of these three, I'm going to show you some charts from Rex in a second. But let's look at Apple, and then I'll show you Microsoft and Google. So here's the Apple chart. Right now, it's a critical support, 200-day moving average. You see how well it's held. And like when you look at charts like this, where you have a support line that's held so well over a long period of time, what tends to happen is if it breaks with conviction, like it closes below it, right? Not just intraday, but closes below it on volume or something like that, right? Then like it's really bad news. Like the thing can go down much, much further, right? So that's something chart-wise to look at with Apple. So, I've been having this kind of philosophical debate with a bunch of colleagues over the last week, and one of them is Rex. You guys know him as a technical trader. We give him, show him some charts, but he really includes also fundamentals, and his opinionated in terms of his bias if something goes up or down based on macroeconomics. So that might be going into these charts a little bit, but he sent me these charts today, left on Google, right on Microsoft, and he said some of the best shorts to come soon. So I was happy to see that from him because he has not been in agreement with me the last few weeks. He thought we were going to bounce and head higher, but now has changed his mind a little bit. For the record, he thought long term, we were intermediate term, there's going to be a big crash. He just didn't think yet. But now he thinks it's pretty much the time. So we could both be wrong, but that's what we got for you. So again, investing is anticipating the anticipation of others. So that's why I'm anticipating that at some point, greater recession talk is going to be coming into the mainstream on CNBC, et cetera. People are going to be starting to talk about, hey, our iPhone sales going to be as great. So I'm trying to anticipate that, right? So going back to how do I get these trade ideas? That's how I do it. So, but what about the Fed? The Fed meeting is this week, Wednesday. And, this week is going to be a really consequential week. It may be perhaps the most consequential week for the entire year for the stock market. Not only do we have the Fed decision, but there is some chatter. There's a fourth peace meeting in the next 2 days. That's been confirmed. The status of that peace meeting, is it something important or not? Is there progress or not? That's a little bit foggy. But, I think that Russia's in a really tight spot financially and militarily. And at some point, they're going to be looking for a way out, is my opinion. So between that situation and the Fed, I think this week can really be super consequential. So can the Fed perhaps save the scenario I just showed you of all those charts? And they save the day. That's going to be on Wednesday. Well, here's a couple charts I want to show you. I think the Fed is behind the curve and stuck between two bad options. The left chart shows you the inflation rate, the top line, compared with the interest rate. And as you can see, right, if you want to be not behind the curve, you got to raise those interest rates very tightly together with the inflation rate, right? You want to be on top of that. Over here, look at this gap, a gap that we've never seen, how large this gap is. They haven't raised the interest rate yet, and there's the inflation rate. So then I saw this other chart, which was pretty concerning, that someone shared, that this is when they say behind the curve, this is why it's so important, right? If you hike proactively, maybe asset prices don't boom. They'll just go up a little bit slower and you'll have stable pricing, right? But if you hike, really late, like that seems to be here, you start raising interest rates really late, what do you get? You get this huge artificial asset boom, and then boom, everything kind of crashes, right? So I think this is further validation and further kind of information that validates what I've been saying about the possibility of the Nasdaq falling another 20% or so to the 200-week moving average. And for me, that's just a starting point, because that's still within the bullish channel. Remember how far we've come up. Every other stock basically back to their pre-COVID highs, everything, right? Or below that, except like Apple, Google, and Microsoft, and a few other mega caps. Like, why should they be excluded, right? We'll see what happens. So, they're stuck in a place that's pretty difficult, because if they raise too aggressively to combat inflation, you risk this, an asset price collapse. And again, if they raise less aggressively, then inflation can keep on going, and it's really complicated. Do we get stagflation? Do we not? The last thing I wanted to talk about for now, before I turn it over to James on SMSI, is gold a little bit. And when James is finished, we'll come back and I'll finish up on agriculture and defense a little bit, and then we'll do the Q&A at the end. But gold is something I've been pounding the table on since about 170. And the reasons I got in was twofold. One is, again, I was anticipating the anticipation of others. Why? Because I saw the chatter. I've never in my life seen so much conversation. This started in like September, October with just regular people, laymen, right, about inflation. I've never seen it so much. Every day, anywhere you go, no matter what their level in terms of being in the market or not, everyone was talking about inflation. So I'm like, all right, it started to get me thinking about gold. So I started looking at it, maybe took a small starter position, and then I noticed how the chart, I'll show you the chart in a second, how good the chart was. So I lined it up with the technicals, and I'm like, all right, now it's time to get into gold. But now gold's going up a lot, went from like 170 to 195, and now it's like kind of pulled back to 185, consolidating or trying to figure out what it's doing here. And this week could be really consequential because gold typically has a very strong, or people think it has a very strong inverse relationship with rates. And there's lots of articles on that. You can Google them. Here's the source down here. But this, however, was not true during stagflation of the 1970s, where gold rose 1,600% between 1971 and 1980, while interest rates were going up from 3.5% to 16%. So it's not always true as you raise interest rates that gold goes down. It's primarily seems to be linked to inflation. And if inflation is still going up, even as interest rates are rising, gold is going to go up. So there's not a lot of data, historical data on this. There's only a, few different periods in history where we had this few examples to look at in terms of interest rates and stagflation. But I think this week is going to be pretty difficult. I think it's going to be very difficult to predict how gold will react short term because of this. Like, so if the Fed comes out, do they raise by 0.25%, by 0.5%? How's that all going to impact gold? Is there going to be stagflation? Is there not? I think this week is going to be super confusing. A lot of volatility. And we just got to see how it plays out. But I think there is the possibility gold can do really well the next couple years. We'll have to wait and see. So here's the gold chart, by the way. Look at that. To me, that's a beauty. That's like a classic cup and handle. I'm not a perfect, I'm not a technical trader by trade. I have my own little things I look at technically, but I do recognize this pattern as a cup and handle, and I think it could go much higher. So I'm going to stop there and introduce SMSI. At the end, we'll come back and take questions. And again, we'll go into some agriculture themed and defense themed stocks in terms of Russia. But first, SMSI, very popular, widely held stock in our community. They just had earnings on Thursday. Last trade, $3.28, market cap 221 million. At the peak, it was up 110% since it was officially presented at StoryTrading. I know a lot of people in our community got in around $2 though. So if you got in at that price and you just held, you're doing good. But this past year has been very challenging. The stock was down sharply on Friday. So we invited James back. He's the admin of the community to tell us perhaps what he thinks, and maybe we can get a greater understanding of this chart and why it crashed on Friday to fit into our 4 pillars and help us make better trade and investment decisions. So James, you got the floor.
Awesome. Thank you for that introduction, Ben. So as Ben noted, Smith Micro has taken quite a bit of a hit recently. But for someone like me who's been waiting on it since around $1.90, we're still generally sitting well on this. But the downturn in Smith Micro, I think, is noteworthy. But I think what really pushed that was the downgrading in the analyst estimates for the 1-year price targets is what I think really caused that. Because as far as the underlying story behind Smith Micro goes, it's just the same as it always was, with the exception that we have further confirmation on launch dates, which I'll get into in just a moment. But I mean, as far as where we're at now and where the price is, we know more than we ever have. There's just as much confidence, if not more, in their ability to make money and execute on the plan. So for me personally, and I wouldn't of course, ever dream of telling anybody else how to spend their money, but I'm trying to get access to more money so I can buy at these prices because I'm currently maxed out in what I have, but it is extremely attractive in my opinion at these prices. I don't believe that the drop in price or even where we were at before was justified, and I personally don't think that the broader market is understanding the actual story behind this trade and what's happening. So as I mentioned before, we are set to launch on the conference call. They said they're basically just standing by for support, waiting for them to hit the button. And they quote unquote should launch within the next couple of weeks, end quote. That information comports to what our community has gathered as far as independent research and data gathering. And I would also note that we did recently find out that the family mode landing page for T-Mobile has changed to reflect the 3.0 update. And in the conference call, they said that the Google and Apple store have approved. Sorry, my phone heard the word Google and went off. They have been approved as far as apps go. So we're just waiting on the update to hit and for this thing to officially kick off. Let's see, I'm going through my notes here to see what else was really noteworthy. In the conference call, they did state that Q1 of this year should be the maximum burn rate for Smith Micro. Next quarter should see a slight uplift. It's possible that they're sandbagging their own estimates in order to be conservative, but I would expect things to really start to kick off and ramp up around Q3 onward. So it's great that we're just on a ramp and we're about to go way, way up because they have confirmed, of course, that they are already have contracts with all the major carriers. And I would also note that in their investor relations page for their kits, investors kits, they changed one of the slides to actually have an investment thesis, which I thought was really cool. And they did confirm that these are contracts. They're not gentlemen's handshakes or anything like that. This is going to happen. And they also noted that there's an increased urgency from carrier customers to accelerate migration efforts so that they can offer family safety. So there's been an uptick in urgency for them to get this done, which I would imagine if T-Mobile's launching, AT&T and Verizon are going to want to follow suit very soon, so they're not missing out on a potential money train. It was noted the delays that we've experienced seem to be indicative of them wanting to have a good product whenever it releases that's devoid of any bugs or anything that might irritate the consumer and damage consumer confidence. So with what we've seen thus far, that is of course a risk, but I don't think it's a very likely or probable risk that consumer confidence in the product is going to be harmed. And let me see if I have anything else really important that I wanted to talk about before I hand it over to you, Ben, for questions. Yeah, I think that should be it. The bottom line of it is the story hasn't changed. We have more benchmarks and transparency as far as what's going on, and the price is, I believe, right at a 2-year low, which makes this a very exciting time.
Awesome. All right. So I'm going to ask a couple questions because I'm not as familiar with the story as I used to be. So T-Mobile, we're talking about a few weeks from now. They mentioned on the conference call. What's this? That's for SafePath 2.0, right?
That's for the new SafePath. So
what's the status with Verizon and AT&T in regards to SafePath 2.0?
As far as AT&T, from my understanding, we still don't know too much other than they seem to be lumped up with Verizon as far as when the management speaks about them, as far as their launch dates. They did say that T-Mobile will act as the blueprint or the launching pad for the others. So how they execute this is going to affect Verizon and AT&T. And they had also talked at length on the call about their sales and marketing and the strategies that they've done to, campaign awareness and all of that. So I know that Verizon, they actually have had advertisements for their product already hit the stores on their first round. So things seem to be happening at Verizon, and we can expect more. but AT&T is, for all intents and purposes, kind of just a black box that's lumped next to Verizon.
So are there any channel checks in terms of app rankings we can look at yet, showing any progress with Verizon, or what? How do you expect that to go with T-Mobile? Because that, that's the thing I remember back in the day where a lot of us profited really well. It was because we saw those app rankings coming in and we're kind of able to predict that the quarter was going to be really good. So any sign of that, or when do you expect that to really start showing?
So as far as the community goes, I would expect them to really start doing channel checks once it launches. However, there's someone that I talk to fairly regularly that is a manager at one of the stores who, how to say this, who offered to let me know whenever they get the training slides. I tried to make contact with them before, but they were out due to a family emergency. But if this does indeed start to launch at the end of the month, I would expect the training slides, if they haven't already, to hit very, very soon to the stores.
Okay, but you mentioned Verizon is, I wasn't clear on Verizon. Is Verizon already have a product with SafePath 2.0 or not yet?
I wish I would have gotten the quote from them. I believe that was part of the contract they had acquired, and so they had gotten them as a carrier. So they're still kind of in with legacy.
That's the older product though, right? That's not SafePath 2.0 yet, I guess.
Correct. Yes.
Right. So, okay. So that's not okay. That's the old product that we're using. Yeah, that's what. Yeah, I got a comment in the chat about that. Okay. All right. So really, that's I would be really interested to see the progress once we can look at the app rankings daily. So that'll hopefully start in a few weeks with T-Mobile.
Right. Once they
that'll be exciting.
Apps.
Awesome.
Yeah,
that'll be really exciting. So I wanted to know, get your thoughts, or if the company said anything on the earnings call about. They missed the top line a little bit, the bottom line also as well. I was personally worried about both of those, and I maybe for a different reason, but I'm worried a little bit about inflation here, right? I think like inflation is something that bigger companies can handle better than smaller companies. So is it possible, or did they talk about perhaps inflation hurting on the expense side? What their labor costs look like, or whatever other input costs they have there. Any thoughts on that?
I could be wrong, but I didn't see anything related to that in the call. And I'm not an expert in that particular area, but you're correct, I think, insofar that the bigger companies can handle increased inflation, but with how much this has, or at least has had the purported potential to gain them revenues, at least in the way that it inspired them to adopt this in the first place, I would think that over time they would scale it at least somewhat proportionally. So as far as it really hurting Smith's margins, I at this time don't really expect that to be too much of a concern. But we will see. Like I said, I would expect them to adjust as necessary.
Okay, great. And in turn, the top line was missed a little bit, I believe. What was that attributed to? Did they talk about what the cause for that miss was? Comp Suite, was it? Or was it SafePath? Anyone know?
I believe it was CommSuite, if I'm not mistaken. I didn't catch what the issue was there. I know one of the main things that they talked about was the cash strain that they had that astute people already knew of about $14 million, which was related to the buyout. So yeah, there was something with that, but I don't think anything going on with their secondary offerings like that is really even going to be on much.
Yeah, so nothing. So yeah, I guess from that, nothing is really showing on the demand side being impacted yet because of inflation. The cost side maybe a little bit, but I think that's something I personally would want to look at going forward. Right now, it's just purely speculation and opinion based, and I think part of the reason the macro, when you see S&P 500 or IWM or whatever, you see the macro go down, it impacts basically all stocks. like almost no stock doesn't get impacted. And, I think that's because there's a general thought that, every product will sell less, right? When people have less discretionary income, unless it's, I don't know, food or something. So I think that's something to watch for. We're not there yet at all, in terms of, wow, inflation is, that, inflation, food and gas inflation is food and energy inflation is so high that people don't have money for anything else. We're not there yet, but I think it's something to watch for. And for me, I think that's why when you see a down, that's how to make sense of the markets as far as I'm concerned, right? When there's macroeconomic concerns and the major indices are down a lot, well, it would make sense that, investors would also say, hey, SMSI should be down too, because maybe they'll sell less stuff also, right? So I think that's something to watch for. But T-Mobile is so big, perhaps it doesn't make a difference, right? Because they're going from down here to up there, and maybe it's here instead of there because of a little, inflation. Not inflation, but again, lower discretionary income because of the food and energy inflation. So it's something to watch for. But that's great news. We're only a few weeks away from T-Mobile. I think it will become clear, hopefully soon, what trajectory it's going to take. So we'll be watching closely.
Right. And I would expect, if I'm not mistaken, the last time I checked, this was actually pretty heavily held by institutions and long-term investors. And I think that once the proof starts to come out, that's really going to motivate the institutional buyers that aren't actually in the stock right now. And just generally some comment on inflation. I personally kind of expect it to increase, mostly because 35% of all U.S. currency ever printed in the United States history was printed in 2019. Yeah. And I suspect a good bit of that was done in support of the stimulus payments. And generally speaking, again, I'm not an expert economist. When you introduce more money without adding significant value, that tends to what drives inflation. And in your example about the 1970s, back when inflation had a spike to like 15%, a lot of people were scared. They were scared that they were going to enter a hyperinflationary environment.
Do you see the chart? I pulled it up real quick. That's
institutional.
I see it. How this is 21. Oh, why did it only show? It only shows 1 year data. I don't know why, because I'm pulling up a 5-year chart. But anyway, you could see that there.
Sometimes
little bit of a drop, but I mean, between 50 and 54%, not really meaningful, I don't think.
Yeah, no, I wouldn't consider the drop meaningful.
All right, great, James. So hang around at the end. I got a little more to talk about on Ukraine. Then we'll circle back and do a Q&A on SMSI with James and any other topic. So yeah, if you're not part of the story trading community, you can become a VIP member. Join us in the collaborate in the SMSI research group. Thanks, James. We'll be back to you in a couple minutes. So, yep, I want to continue on this Russia, Ukraine megatrends and get into a couple specific sectors that we've been talking about. Agriculture is the one I'm actually most excited about. Defense, I'm not like excited about, but I did some research on it. I like it. I like it long term. As you know, we'll talk about it. But since I did the research, I'm going to share it with you guys. So, agriculture. I really like these agriculture plays better than the whole energy sector, because of two reasons. Well, a couple of them. Let's go to the background first of what's going on with agriculture. So Russia, Ukraine, for those of you who haven't figured out yet, is a breadbasket of Europe, right? In terms of wheat and corn and fertilizer and soybean. And they export this stuff to all over Europe and also Africa. So we know the sanctions are impacting exports from Russia. And obviously the war impedes productivity and exports from Ukraine. And again, Africa and Middle East rely on imports. So what's a bullish thesis here, especially over oil? You're going to have less demand destruction than oil, right? People can fly less, go on vacations less, whatever it is. If oil is, gas prices are too high, but eating less, there will be some demand destruction for sure for some people, but it'll be less than oil. Also, a huge factor is you can't quickly increase the supply like you can with oil. OPEC can't just make a decision to increase the supply. There's all kinds of other deals they can do with other nations to get supply. You can't do that with with wheat. I mean, it could take a year. I'm not, I'm not an expert in this area, but I did read, it could be a year and a half in terms of the planting cycle and the seeds and everything that goes into it. So short term, other countries have to try to fill this gap. And unfortunately, there could be a problem. There could be, aside from just investing in money, unfortunately, we could be in a pinch here for really poor nations in Africa. There could be famines. I mean, there could be greater geopolitical and unrest and people fighting over food. It's not a pretty situation. So that's something to really consider. And again, I think because of this, food security is huge. So who wants to be in a situation where they can't control and have, security and enough food for their own population? So I think this is going to be a huge area of investment by countries all over the world who are looking to expand their agriculture sector so they can be more self-reliant. So for that reason, that's why you see the whole agriculture sector taking off. And we'll go through a few examples. But the first thing that I've noted, now that the price popped, I didn't want to say it by name last week because it was a micro cap, a really small micro cap, like 20 million. But I had this quote last week. This is ARTW. They sell agricultural manufacturing equipment. And in their most recent press release, they had this passage here, which is really powerful as far as the whole agriculture sector goes. We'll talk about RW in a second specifically, but the whole ag sector. Two things that, in the first line, you can see that there is definitely a correlation between people buying, and maybe it's not explicitly said here, but I know from other sources, there's a correlation between higher commodity prices and more agricultural equipment being sold, right? When farmers make more money, that's what they do. They take that money and they invest in new equipment and more equipment. All right. The second thing is that they have their own higher input costs because of inflation. But guess what? They were able to pass on all of those costs to their customers. In fact, in the case of RW, and again, this is all before the war, in the case of RW, they're able to even increase their margins, even though their input costs went up a lot. They were able to, raise their prices even more than that, and have a really good quarter. So you got to be careful with RW. I ended up selling half of it in after hours on Friday because I got in at like 460 and I think I sold it like half of it is 550. We'll see what happens tomorrow. But look at these other plays. So commodities, the whole agriculture sector. We're going to go through all of them, right? Real quick. So DBA is an ETF that gives you exposure to all sorts of commodities, or you can do WAT, corn, soybean. I don't like these too much because it's very difficult to trade or predict commodity prices. Perhaps it's already peaked, but even if it's peaked, that's still great for all the other agriculture stocks, right? It just needs to be high. Doesn't matter if it goes up or down anymore. It just needs to be high for them to do well. So these are pretty risky. And thanks to Matt S from our community, we were on top of IPI real early, probably the winner on this page, up 76%. Potash, huge export product from Russia. Mosaic, a larger competitor that's perhaps less of a pure play, up 40%. And there's another one, CF, we didn't talk about much, but up 25%. So those are the potash plays. I'm not saying you should buy any of these, by the way, just letting you know the names that are out there, because a lot of these are up a lot already, right? Then you have Deere, up 12%. So again, I think this is potentially a mega trend play, right? Deere, maybe they're going to sell a ton more equipment to all places, places all around the world as they look to decrease reliance on Russia and even other places, right? So then we got a new list that I wanted to touch on from Sanjay last week. What did we say? From War Warning. Okay, I'm going to show you the percent returns. All of these percent returns are from the morning of the invasion. What price were these stocks the morning of the invasion, and what were they Friday at the close? That's what all of these are up here. Same thing. So he gave us a bunch of names. Don't have time. I wanted to do a deep dive, but just didn't work out. CNHI, you can look into it, up 13% so far. The PE of 12, 2% dividend yield. AGCO, PE of 11, 15% up so far. So I bring these up because, again, these are areas that may have been underinvested in. You look at that note from Merrill, agriculture, the new FANG, I don't know what's going to happen with these PEs. They're going to inflate to 20 or they're just going to make a ton more money. I don't know, possibly. So land is very interesting because this is a real estate company that buys like farmland and leases it out or sells it. I don't know exactly what they do, but they have a 1.5% dividend yield, up 28%. LNN, nothing jumped out at me this one either real quickly, but TWI really jumped out at me over here. Q4, and this is probably why it's up the most on this whole list. Q4 EPS is 44 cents. And man, you got to look at the growth and the commentary on that PR. Very, very bullish commentary in terms of commodity prices, agricultural commodity prices, and how it helps their business. And again, that was before the war, that commentary. So TWI, a very interesting one to look into. Let's jump to defense plays. I did a whole bunch of research on this. So personally, I could be wrong, but I think you could have a tremendous amount of investment going into specifically missile defense because Russia passed that red line and started threatening nuclear stuff, so I think that you're going to see governments over the coming years wanting to spend more on missile defense, decreased trust, nuclear war worries, missile defense top priority. By the way, Russia is significantly ahead of U.S. missile defense capabilities. They could wipe us out if they wanted to, but we still have deterrence. Don't worry, guys. We still have mutually assured destruction deterrence because they cannot strike our submarines. That's all over the world, and our submarines can guarantee that Russia's completely destroyed in a matter of a few minutes. So because of that counterstrike capability, even though our missile defense is not up to speed, so we're in good shape. But this only works if people on the other side are not suicidal, right? That's mutually assured destruction, right? So if one day you get like a real madman out there who's hell-bent on destroying the world, then you do want to have that great missile defense system. So I think you're going to see a lot of money coming into this. So I really looked into this and I found out, a couple of weeks ago, I mentioned ETF PPA, because I didn't have time to do research. I said, let me just get into a defense ETF. So I did that. But I found out in terms of missile defense, did some deep research. There's 3 areas. There's ballistic missiles, mid-course missiles, and short range. The ballistic missile defense, it's Raytheon, Boeing, and Northrop Grumman. They work on that together. They have all the major contracts with the government, and they're bound, if we grow, it'll be with those companies. Mid-course, intermediate term range, it's Lockheed Martin with the Arrow defense system. And then you have this company from Israel. I don't know, I don't know the name of the company, but that's the ticker symbol. It trades only in the Tel Aviv exchange. That's THAAD, THAAD. And then short range, you got the Patriot, and that's Raytheon. So Raytheon is repeated a lot in here, by the way, when I was doing this research. You see it listed twice here, but they're definitely come up a lot. For me, I thought the best pure plays on this was Raytheon and Lockheed Martin. So I actually rotated out of PPA into Raytheon and Lockheed Martin. And these are just long-term holds for me in my IRA. I'm just going to hold for 5 or 10 years at this point, unless, of course, the price explodes or something. I know they already went up significantly, but that's what I'm doing. I just think there is a long-term play here for missile defense. This one really looks good if you can access it. It's an Israeli company. All right. So that's all I got. So if you're not a VIP member, again, you can collaborate in our community. We have a Russia-Ukraine War Ideas room. We'll get to Q&A. That's not going to be on the recording. So those of you who are watching on YouTube, you can head over to our website, check out our events coming up. You can follow us on YouTube, follow us on Twitter. Oh, we're also on Spotify now, storytrading.com/Spotify, all of our events and audio only mode you can capture over there. So we're going to say good night to our social media folks watching this on a 1-week delay.